Imagine receiving an inheritance, something meant to secure your future, but then discovering complex rules could complicate accessing those funds. It can feel like navigating a maze, especially with retirement accounts. For non-designated beneficiaries of an individual retirement arrangement, also known as an IRA, the 10-year rule generally dictates that the entire inherited account balance must be distributed by the end of the 10th calendar year following the original owner's death. This rule stems from the Secure Act of 2019, a significant piece of legislation that changed how inherited individual retirement arrangements are treated. Before this act, many non-spouse beneficiaries could stretch distributions over their own life expectancy, allowing the funds to continue growing tax-deferred for decades. However, lawmakers aim to accelerate the payment of income taxes on these inherited accounts, hence the introduction of the 10-year rule. A non-designated beneficiary typically refers to an entity that is not an individual person, such as an estate or a charity. It can also refer to a trust that does not meet specific requirements to be considered a look-through trust for distribution purposes. Since these entities do not have a measurable life expectancy, the previous stretch option was not applicable to them in the same way. The 10-year rule now provides a clear, albeit accelerated, timeline for distribution, ensuring that the tax deferral period concludes within a decade. So, what does this mean for a non-designated beneficiary? The most crucial step is to be aware of the 10-year deadline. This means the full balance of the inherited individual retirement arrangement must be withdrawn by December 31st of the 10th year following the original account owner's passing. It does not necessarily mean you have to take equal distributions each year, but the entire sum must be out by that final date. Planning for these distributions is key to managing the associated tax liability. An important nuance here is that required minimum distribution rules, often called RMDS, do not necessarily apply during the 10-year period for non-designated beneficiaries who are not eligible designated beneficiaries. Instead, it is the full distribution by the 10th year that is mandated. This gives some flexibility in when to take the money out, but it also places the burden on the beneficiary to proactively manage the withdrawals. For example, if the 10th year falls in a year of higher income for the beneficiary, taking the entire distribution in that year could push them into a higher tax bracket, underscoring the need for careful tax planning. Understanding the 10-year rule for non-designated individual retirement arrangement beneficiaries empowers you to make informed decisions and avoid potential penalties. By recognizing that the entire inherited balance must be withdrawn within a decade, and planning for the tax implications of those withdrawals, you can effectively manage this inheritance and integrate it smoothly into your financial strategy, ultimately securing your financial well-being.